Now let's move on to reversal wedges. The first pattern to consider is the falling wedge, a bullish reversal formation. This means that as the price trends downward, a falling wedge forms, signaling an impending reversal to the upside. The wedge consists of contracting price movements, and when we connect the highs and lows, the two lines gradually converge. The key logic behind the falling wedge is that sellers lose momentum with each price movement, causing the wedge to narrow progressively. Once selling pressure weakens enough, buyers step in, breaking the price out of the wedge to the upside. The optimal entry point is when the price retraces back to the upper boundary of the wedge to test it as support. A logical stop loss is placed below the lowest point within the wedge, while the target should be at least 3 times the stop size. Next, we have the rising wedge, a bearish reversal pattern. Here, the price trends upward before forming a rising wedge, signaling a reversal to the downside. Similar to the falling wedge, this pattern consists of contracting price movements where the two trend lines converge over time. In a rising wedge, buyers gradually lose strength with each price movement, leading to a narrowing structure. When buying power diminishes significantly, sellers take over, breaking the price downward. The best entry occurs when the price retraces to the lower boundary of the wedge to test it as resistance. A stop loss should be placed above the highest high within the wedge, while the target should be at least 3 times the stop size. To complete our discussion on reversal chart patterns, let's explore expanding triangles. The bullish expanding triangle is a bullish reversal pattern, forming when the price moves downward before expanding and signaling a reversal to the upside. This pattern gets its name from the widening price movements, indicating increased volatility. The logic behind this reversal signal is that the dominant market players, sellers in this case, are pushing the trend to its extreme with increasingly larger price swings. Once their momentum exhausts, buyers take control, leading to a reversal. Unlike the falling wedge, where sellers gradually lose power, the expanding triangle signals the final aggressive push before the trend reverses. To trade a bullish expanding triangle, wait for the price to break above the upper boundary and then retrace back to test it as support. A stop loss should be placed below the lowest point in the pattern, and the target should be at least 3 times the stop size. Similarly, the bearish expanding triangle is a bearish reversal pattern. It forms when the price trends upward before expanding and signaling a downward reversal. Like its bullish counterpart, this pattern exhibits increasing price swings, reflecting heightened volatility. In this case, the buyers dominate initially, driving the price higher with progressively larger movements. However, as they reach exhaustion, sellers take over, reversing the trend. Again, this differs from a rising wedge, where buyers gradually lose strength rather than making an aggressive final push. To trade a bearish expanding triangle, wait for the price to break below the lower boundary and then retrace back to test it as resistance. A stop loss should be placed above the highest high in the pattern, with a target at least 3 times the stop size. This concludes our discussion on reversal chart patterns.